Good morning, everyone. I'm Sherry McGuire here at Longwood. I think I know just about everyone in the room today. We have the pleasure of having Kim King here from Benchmark. And as you know, Benchmark Community Bank is a premier sponsor of the RISE Collaborative and Rise and Shine. And we are very pleased to have their expertise at the table today, in particular with helping businesses build credit and understanding what the different elements are to having a good credit score. To introduce Kim very quickly, she's worked in finance and real estate for over 35 years. Her career started as a teller and she went on to become a realtor. After about 5 years, she recognized that she enjoyed the financing part of buying a home. So she transitioned into a role as a mortgage banker, then with First Citizens Bank. And after about 8 years, she decided she wanted a new challenge and she moved to business banking. She's also been a branch manager. She has a passion for helping people make a better financial future for themselves. And as a relationship development officer, she gets to do that every day by guiding customers through whatever processes are necessary for them to meet their goals in financial growth and owning a home, building a business, all of those different factors. So Kim, it's a delight to have you today, and I'm going to share my screen. Kim and I have talked a couple times this week, and I realized very quickly she has so much to share that I'm going to be in charge of the slides and flipping those, but she's going to be our primary presenter today. So make sure I share the right one here. Can everyone see that screen? Okay, cool. Kim, take it away.
Thank you, Sherry, so much. Thank you for having me. And just want to go over quickly some of the things about credit. Sherry asked me to share, and this is one of my favorite things to do, by the way. So just want to start out with information about credit scores. Basically, a credit score, most of you know, is simply a summary of a person, how a person handles their finances. And of course, it's everybody that lends money, that does insurance, that's usually one of the first things they go to before they move on with the person with whatever requests they have. A bad credit risk is, of course, is someone who has a history of not paying bills on time and repaying their loans. And that's something that I pretty much specialize in with my customers. I help a lot of my customers build their credit. And so creditors, use credit scores to gauge risk. The higher the credit score, the lower the risk. And with the lower the risk, the lower the rate, the lower the insurance premium. So it has an effect on a lot of those things. Developing credit scores, as far as that goes, it sets parameters. A credit score is just simply parameters that we try to stay within. And most companies have a minimum credit score that they will not, help you or assist you if your credit score is not at least a minimum score. And of course, you can't have a credit score too high. I can tell you that right now. So credit scores were created so that everybody had a place to start and a place to look at to get some kind of idea, because most of the time you're dealing with people that you have, you don't know. Luckily, at Benchmark Community Bank, we know most of our customers, so we look at their credit score, but we also look at some other things. But that's where we start. So there are 3 reporting agencies: Equifax, Experian, and TransUnion. And each one of those, if you pull one person's credit score the same day, a lot of times you'll find they'll have a little bit, the scores will be a little bit different. And that's because each entity reports to different credit bureaus. So there may be some information on one that's not on another. And so that will have an effect. So that's why most of the time, if you go for a mortgage, for instance, they're going to pull a tri-merge, which is all 3 credit bureaus. And most of the time they use that middle score. as their score that affects the rate basically, and whether you get the loan or not. So developing credit scores, basically the things that influence a credit score are payment history, which of course is the biggest portion of that, the amount of credit that you use, basically the amount of credit, that 30% right there, that's actually also the limit that you want to put on your, in other words, if you have a credit availability, you never want to get above 30% of that available credit, because that will lower your credit score. The length of your credit, credit history is really good. That's why it's not good to like cancel a credit card. If you have a credit card and you're not using it, if you close it, it actually will take your credit score down some. And we'll get into that in a few minutes. I'm going to give you guys some tips on that. New credit, every time you open a new credit line, it usually does reduce your credit score for a short period of time. And types of credit are important. And the types of credit that usually what they call perfect credit is a mortgage, an installment loan, and 2 revolving credits. If you have those on your credit report 9 times out of 10 and you handle them well, your credit score is going to be pretty good. Now, credit score ranges, if you go to that page, I found this pretty interesting myself, because actually I had never seen this in writing until Sherry sent me this. I honestly can say I've never seen a credit score of 300. I've seen them pretty low, but never 300. So if you look at this range, the low range, 9 times out of 10, if you're within the 300 to 550, it's going to be pretty hard for you to get what you're applying for. 550 to 620, usually 580 up to 620. You know, you probably could do something with that as far as it helping you get something, but you're going to pay a higher rate and things like that. 620 to 680 is probably where a lot of people are right now. The vast majority, and I wish I had a tally of that. That would be interesting to see, but I don't have that information. But 680 to 740 is pretty good, guys. And if you're 680 to 740, you're going to get a pretty decent rate, pretty decent premiums, whatever, you know, that credit score is being requested for. But 740 to 850, that is considered excellent. And most of the time, that's where you're going to get your best pricing, your best rates, and the best premiums. So, of course, better rates mean less cost. You get better terms and better insurance premiums, as most of you know, probably know that when you even apply for insurance, they're going to pull your credit just to see where you are. And it also establishes a little bit more trust between you and your lender or your creditor or whomever you're doing business with. So building a credit score is very important. And I work with a lot of young people or a lot of people that haven't used much credit. And unfortunately, if you use a lot of cash and don't use a lot of credit, believe it or not, there are people that have come in here that have plenty of assets and do very well for themselves, but they've never used credit. So when we go to pull a credit report, there's nothing there. So that's something else that people don't realize, that you have to use, you have to establish some credit. Even if you don't use it as much, you still have to establish it. And that is something I like helping people with as well. So let's say that you have a young person in your life that is getting ready to go to college or whatever, and you're trying to help them establish credit. The best thing you can do for them is either put them on your credit like if as a parent, put them on as a on one of your credit cards, for instance. That helps helps build their credit, and it's sort of safe and gets them up there until they're ready to do their own thing. Once they get a score, you just add to that a little bit at a time. I've even uh, advised people to do a small loan, and use the funds to make the payments. Even if they don't need the money, it definitely helps them, develop credit. So you could open a line of credit, use it for necessary items like groceries and gas. So, like, you're not overspending or getting yourself in trouble. You're basically using it just to build credit. And you have to, of course, make those payments on time. Um, and that will help you build that credit. We also have, I'll share that with you in a minute about how to build your credit if you have bad credit. So, and keep in mind that credit reports work from a percentage standpoint. Basically, if you have, it doesn't matter whether you have things on your credit that are negative, that are $10 in negativity, or $10,000, believe it or not, because it doesn't look at the amounts. It looks at the, it looks at the fact that you have issues on your credit that may be negative. So a lot of people think, well, oh, it was only $30 and it was the principal of the thing. Honey, let me tell you, if you got something on your credit you need to clear it up, go ahead and take care of it, whether it's principal of the thing or not, take care of it, and then you can clear it up later so it doesn't have an effect. So always make sure that you keep your revolving balances low, and that's where that 30% falls into. And that is the ratio rule, by the way. And avoid applying for lots of new credit at one time. You can build it up a little bit at a time. For instance, if you, let's say you go out today and you purchase a new car and you get an installment loan, well, that installment loan, when you get it, it's going to dip your credit down a little bit until it shows that you're paying your payments on time and that kind of thing. And then it'll pop back up. Credit is sort of counterintuitive, because you think if you pay things off early, you would get, extra credit for that. You don't. You just have to make sure that you pay at least your minimum balances on time every month. And I tell people all the time, you can be 29 days late on something, but do not be 30. Once your payment hits 30 days late, it's going to put a mark on your credit, and it's really going to dip it. And I'll just give you a personal experience that I had, and know this for sure, is I had a credit card that I never used, and I used it for something. Well, I just didn't use it very often. And for some reason, I did not pay it. I just forgot about it, forgot I had it, even had a balance on it, didn't have it set up because I hadn't used it, for minimum payments or anything like that, and forgot to pay it. My credit score dipped with that 130-day oversight. It dipped 70 points. Of course, it came back after a few months, and they realized that I was paid, that I do pay my bills. It did come back, but it took a little while. So vary your credit mix. That's where I was talking about. If you have a mortgage, an installment loan, 2 revolving credit cards, that helps build your credit score up as well. And I'm so glad Sherry had this on here, the credit report that you can check annually for free. That is a wonderful place to go. And it's a place that I send all my people to when they come in and say, hey, I need some help with my credit. So this is what I usually advise them to do. So we go to that www.annualcreditreport.com, and you can choose which credit reporting agency to pull. And you're entitled to one free credit report from each credit reporting agency once a year. So we start with, what I normally do is I start with some of the, like I'd start with Experian and say, hey, go ahead and pull your credit report from Experian. Let's see what's on it. Let's see what we need to do to increase it or make it better, make sure there's nothing negative on there. And so we pull that one. We take care of that particular credit report. We go ahead and do what we need to do. And let me tell you, if you have negative stuff on your credit report, it takes a little while to get it off. So we'll pull that, we do what we need to do, and we wait 60 days because it takes that long for that, for that credit to show up on the other credit reports. So then the next thing we do is we go to the next credit reporting agency and we'll pull from that. And I always save Equifax for last, just because it seems that Equifax probably has all of the credit, that a lot of people report to that. So that's the one that we save for last. And once we get to that one, 9 times out of 10, their credit score is already going up and we're already seeing a difference in that. So that's how we do that. So tricks to increase the credit score, basically, if you don't have good credit, you would want to establish some good, you need to establish some good credit, but you don't have good credit because there's negative issues on there. You want to take care of the negative issues, but while you're taking care of the negative issues, you also want to be building up your credit as well. So you would pay off the negative information, like if there's collections on there, things like that. You take care of all of that. And in the meantime, you use whatever means you have to develop newer credit. Like, for instance, if you have a bad credit score, you're going to have to do, some other things. Like you can do a cash secured credit card. You can do a small loan on something with a big piece of collateral or something like that, so that your creditor does, feels comfortable with that if something happens, that they're covered and their risk is low. So those are the things there's a lot of things that we can do to help build it, but it does take some time. And our discussion today was, basically I was asked to talk about personal credit scores versus business credit scores. And of course, if you have a business, you definitely want to keep your business finances separate from your personal finances. Personal guarantees, I can tell you most of the time, are definitely necessary to get a loan, especially when you're developing a new relationship with a lender. So for us as a bank, we do normally require personal guarantees until the business has built itself up. And, I talked a little bit about this to Sherry. Business credit is linked to your business by the tax ID number, and it does stand, we look at that, but most of the time, whoever owns the business, the owners of the business have got to have good credit in order to get credit for the business. So it's very important that your personal credit be good. So again, that's something that you don't get into business credit until you get really, really big, like with Dun & Bradstreet. You hear that a little bit. As a community bank, we don't even use that, but there are bigger banks out there that do use that. But as far as our area, most of our businesses are fairly small, and their credit scores, their personal credit scores are what get them up and going and what they use when they're doing business. So that's something that's why it's so important to keep it in good standing. So we do a lot of business loans. Benchmark does, and we have a good reputation of really helping our customers. So basically, if we can cover, if they have good credit, they can pretty much do anything they want. When I go out and I work with young people or people with credit issues, we have to find out where they are. When we start, we have to find out where they are. So if we pull a credit report and it's negative, of course, we're going to work on it and try to build it up for them and help them get where they need to be. But if they're already in good standing, basically they're doing these things. They're keeping their credit cards at 30% or less. They're trying that, most of the time they don't carry balances on their credit cards. And they don't, they keep their history, because once you close a loan, not close a loan, but close a credit card, something revolving, it does affect that history. So if you've got a credit card and let's say you have $10,000 on it and you haven't used it in years, a lot of people say, well, if I close my credit, I'm going to close this credit card because I haven't used it. When you close that credit card, you actually close the history, which is one of the important factors that count in your credit score. So if you ever have issues with, if you pull something and you get a credit report, a lot of people will find that there are little collections on there, especially medical collections. We run into that a lot. That will take your credit score down. But if you have something like that and they don't know it, most of the time they have no idea that it was, that it was on there. So if you run into anything like that, the best thing to do is go ahead and take care of that immediately, and they will, they'll disappear off of your credit report. So basically, I just want to go over a little bit about how long things stay on your credit, and this is why it's important to take care of it quickly. If you have a collection on your credit report, it will stay there for 7 years. And it'll have it as time goes by, it won't have such an effect on your score, but it does stay there for 7 years. If you have a bankruptcy on your credit report, it stays there for 10 years. Even after it's been dismissed, it still shows up on your credit report so that your creditor knows that that has happened in the past. And of course, everybody knows there's several different types. A judgment stays on your credit report for 10 years, but it actually stays in place in the county it was recorded in for 20 years. And then the creditor actually has the ability to go back in, or has the option to go back in and renew that judgment for an additional 10 years. And that's scary. So I always tell people, a collection can truly, a late can become a collection can become a judgment. So, stay on top of your credit. It's always a good idea to have some kind of credit score program that you can check into on a regular basis. I use Credit Karma. I like that because they pop up, nobody really keeps credit at the forefront of their brain, but it'll pop up and say, hey, check your credit score, see what's new, things like that. So it helps you to stay on top of it in those situations. And like I said, things will pop up that you don't even know are there. For instance, the medical collections that we see, most of the time they get on there because they've sent out a statement. They've sent out one statement, and, you're expecting your insurance company to pay for it or something like that, and they don't. Well, they don't send you out any more statements, and they don't chase you around like some of your creditors or your vendors would. So it gets sort of lost. But when it shows up on your credit report, it's already there, so it's going to have an effect. But with something like Credit Karma, it will let you know when something's popped up on there, derogatory, immediately, so you can go ahead and take care of it so it doesn't have such an effect. So pretty much that's, that's all I had to talk about today. And if there's anybody that has questions, I'd love to take your questions. I hope that was information that you wanted to hear. You know, it just takes time and effort, consistency, a little bit of restraint, accountability, and resolve when it comes to fixing your credit report. But these things also have to be in place for you to keep your credit score in a good place.